Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel and welcome to the Daily Gold podcast. This is being recorded at the end of the week on Friday afternoon, January 3rd, 2025. I'd like to wish you all a happy new year out there. And with me today is Professor Vince Lanci. You know him as Professor Vinny. He also runs a great Substack titled Gold Fix. So Gold Fix at Substack, and we do these monthly updates at the end of every month. Professor, great to talk to you again. A lot to talk about today. We're going to try and do it in a little bit shorter of a window than we usually do. First thing, let's get right to the end of the last month. I mean, from my vantage point, I look at technicals first, and we talked about silver exactly 1 month ago. Can silver close above 32? Because you have that resistance on the yearly chart, also the monthly and quarterly chart, if I remember correctly. So $32, it looked like in the middle of the month, silver was at 33, had a chance to get there, failed, closed the month in the 29s, I think. So to me, that was the big takeaway, that we're just not quite ready, I guess, to run yet.
Yeah, I mean, I think last month you nailed that in the sense that we both liked silver. We knew that the end of the year could give a replication in silver of what happened to gold last year, and it needed to settle above a price, give or take. And I think you had 32 as a level. And it's almost like the marketplace heard it because post the election, uh, gold got hammered and stabilized. Silver got hammered and did not. So there you have it. And part of that has to be the Powell concept too, where he said he wasn't going to ease as much. That didn't help as well. So yeah, 20 going into 2025, there are bullish secular drivers in place for silver. There are actually physical demand indicators out there as well. But if you're using charts alone, and there's nothing wrong with that because charts discount what we don't understand yet. And that says we should not be getting crazy yet. I think we're below all the moving averages too right now.
Right. And yeah, technical comment I mentioned in one of my videos, um, and not to scratch my own back, but I for my master's thesis, it's an international program from the International Federation of Technical Analysis. That's how I got my master's designation there. You had to write a thesis, and so it's something I was noticing is the 400-day moving average is actually a better sell signal than the 200-day moving average. So that's something that I proved in my thesis. And so looking at silver, I'm looking at that 400-day moving average, which I want to say it's like in the 20, it's around 2700 right now, or at least it's pretty close
Okay.
to that. So if you look at the last, 4 or 5 years or whatever, you can see silver has quite a few times it's come down to the 400-day and bottomed there. So when markets, and I do this for all markets and stocks I'm looking at, when they come down and they kind of struggle with the 200-day, I always lay on the 400-day, let's see where is that in the particular chart. And so with respect to silver technically, obviously you're right. It's struggling with a 200-day, but the 400-day is coming up. I mean, it's not quite there yet. Like I'd love to see it get to 29. I see a lot of support at 29, Professor. But I
Right.
think it's at about 27 right now, if I remember correctly. So
Okay.
that's going to take a couple months for the 400-day to get up to the 29. But anyway, you know, just stop me from babbling here. The shorter term point is if silver's weak for 2 or 3 months, that's fine because the 400-day is going to come up and get to 28, 29
Right.
fairly soon.
Right. Right. So I know that we're limited on time, but this is the first time I'm hearing this. So the 400-day moving average, is that for silver specifically or for markets in general that you've noticed that in?
It's for markets in general. When I looked at it, I tested it with a number of different market, S&P, Hang Seng, gold, copper, commodity prices.
Uh-huh.
So I looked at it for all those markets. So that, yeah, it's just a technical trick to keep in mind when a market is struggling with the 200-day. And specifically what I looked at is basically when a market loses the 400-day, that's a more meaningful sell signal than when it loses the
Right.
200-day. Now, obviously,
Right.
you don't want it to lose the 200-day because if you're long, that could be more of a
Right.
decline. But that's what the thesis was in terms of being a sell signal.
That's interesting because I mean the the UBS put out a comment that they think silver's going to $38 in 25, and I was out of the blue, and they don't really do a lot of silver stuff, and their commentary was they're recommending to clients to start adding longs between, I kid you not, between 26 and 28.50. And they thought it would bottom out between 20, as low as 26, but usually they're going to start buying at 28. And they were deciding to tell their clients to do that by selling puts. Now, we're not telling anyone to do that, but that's what wealthy people do. But anyway, when I read that, I went and did an analysis using moving averages. And I did not use the 400-day moving average. This isn't me like, saying, let's prearrange this and talk about it. I used the 200-day moving average. And then what I did was I added volatility to it. Up two standard deviations, down two standard deviations, up four, down four. And I got 27 as my low on that area and 28 as my high. It's a complete coincidence. I didn't futz around with it too much trying to make it fit my idea. But I have the charts for that. I can show you that. But it comes in. Maybe I'm accidentally creating like the 400-day moving average. I could
Yeah.
ride on your
Yeah, yeah,
coattails there.
yeah. Do you have a
Should I
chart to
show
show?
that?
Yeah, go
Yeah,
ahead.
yeah. I mean, it's two charts. It'll take like a second.
Also, just another thing on top of that, not to cut you off, but
Yeah, yeah.
if you look at silver and you look at a weekly line chart, that shows strong
Right.
support right around 28. So that's also another indicator of the potential really strong support around 27, 28.
Okay, I see. So obviously this chart probably isn't showing up as well as you'd want it to if you're watching this, but I'll help you out there. The moving average, that's the 200-day moving average, and it comes in at 29.78. Now the light blue line below and the light blue line above, using volatility because that's what I understand. I came up with I'm looking for a buy zone, not a price, right? So 28.48 is where it comes in underneath. So I went, okay, that's right around the area that UBS is looking at for the clients. And so then I said, well, but how low can it go? And so there's another one with still the 200-day moving average, but then I just moved it out to 400, I'm sorry, four standard deviations below and above. And that comes out to 27.18. All right. So if you're trying to figure out like what you're looking at there on that chart, that's a moving average surrounded by kind of like a Keltner channel if you're a technical person. So I went two standard deviations up, two standard deviations down, above and below. And what I noticed is that if you use the 200-day, this is I'm probably backing into your 400-day moving average. If you use the 200-day moving average and you add and subtract four standard deviations from it, you end up covering like 90% of the market. So you know when if it's touching this four standard deviation level, we are really very close to the bottom. And if it touches above the 400 four standard deviation moving average, which it did for half of the year last year, you're definitely overbought and someone is selling it. Anyway, so long story short, I'm probably coming in at your levels by accident, you know? And then the last chart was there's the inside. So basically, I have the two standard deviations and the four standard deviations, and I just drew my oval saying this is the area that I would be a buyer in if it got there. So I'm going to be buying physical. All things being equal, if the market takes a swoon to 20 between 27 and 28.50, and then I'll buy momentum. If I miss that and there's no dip, I'll buy momentum if we get back above, say, the 100-day moving average. I'll watch it above the 200-day. So I think we're coming to the similar conclusions from different perspectives.
Yeah, and
So
I
yeah,
think and I didn't tell you about to the listeners. I didn't tell you about the 400-day moving average, or we could have put it in that beautiful chart that you showed. But I think the 400-day is very close and very similar to
yeah, I'm
probably
going to look at it.
probably both of those lines that you're talking about.
I bet. I bet. So yeah, I
And,
mean,
and by the way, that's also if you're looking at a monthly chart, that's the 20 day, and then on the weekly chart, it's like the 85 or 82 days, something like that.
okay, right, 82
So that yeah,
week.
those are kind of the numbers that I like, and I also do stuff with the 40-month moving average, but that's a whole nother conversation.
Okay, that's
Getting too
pretty.
technical, but but maybe we could do you talked a little bit about silver. Maybe we could do a transition. Uh, I shouldn't say transition, but what does that mean for gold? Because we talked about a couple months ago how silver is the tell for the sector. So if silver in the next couple months is going to test the 400 day, you're probably not going to see gold running away to the upside.
Right,
But
right.
Professor, at the same time, you and I were talking yesterday, doing a little bit of prep for this, and I just texted you, and I think we could have a price bottom. We could the
Yeah,
low could be in for gold. Now, people, that doesn't mean it's going to zoom up to 3,000 tomorrow or next month
right,
because it
right.
can also go sideways. But you look at the 200-day moving average, and I'm sorry I don't have a chart for this. Today it probably hit 2,500, and what was the low a couple months ago in November? Was it 2,540
I don't
or
know. I don't know. But
yeah? Yeah,
I
so many
have
so many numbers in our heads.
I have your movie. You know what? I have your moving average set up. I can just pop that up for you if you want.
Okay, yes, let's
Let's
take a
do
look at
that.
that.
Let's do that. So there's your gold moving average, your 200-day moving average, and I drew like a very wide trend channel. That's a daily gold moving average. To segue from silver to gold, because I think this is actually, I know you're going to get into the fact that gold could have put in a low, and I'm not going to disagree with you. But the misleading aspect of it is not what you're saying is silver continually gets sold like copper now because they think it's economic. So you're a trader or you're a person who's long stocks, and all of a sudden you hear that the Fed's not going to cut anymore, right? You hear that in December after the election, and you say, "Oh boy, what should I sell?" You could sell your stocks. You could also sell copper and you could sell silver, but you're not going to sell gold. And so that's one of the reasons the last month of the year, silver kind of took it on the chin. And, this gold silver ratio is hovering at 90 now. 88 to 90 is the area that it's been in for the last couple weeks or so. Anyway, I guess what I'm saying is that silver could make another low and gold might not. You know what I mean?
Yes,
Like we're
yes,
talking
totally, yeah,
about
totally
right now.
agree.
And anyway, so that's why, this is the time of year that I'm actually I mean, you're going to elaborate on this, but this is the time of year that I look for reasons to get short gold. And I'm not getting uh the vibe that I usually get. So anyway, but you were talking about the why the gold year low of the year could be in. There's your 200-day moving average.
Or yeah, not. I mean, I guess it would be the low for the. I mean, it would be the low for last year, I guess.
Right.
But just in terms of this correction, the price
I'm sorry, the
bottom.
low. I'm sorry, I don't mean to do that.
Yes,
The low is in for now. Jesus.
just the price low. Like it
Yeah.
seems. The 200-day moving out, you see it there at 24.92. I guess my numbers are off a little bit, but that's coming up to 2,500, and you look at that low in November. I mean, I think it's around 25.40, and I mean, you also have. I mean, there's COT reasons, there's fundamental reasons, and a lot of times when gold has been, when we were 2001 to 2011, and maybe during 2018 to 2020,
Right.
you when you have the markets in bullish mode, but it has to do like a big correction, not a huge correction, but
Right.
correct for at least a couple months or 6 months. You kind of you get like that first big sell off and it comes down, and then maybe you get a retest at some point, but like most of the damage is always in that first big sell off.
Well, wait, are you saying that could have been the first big sell-off and we're done for now, or or
Yeah, yeah,
or it's
that
coming
that
up
that that first that first big decline in
post-election?
November. Yeah, November
Yeah.
down to 25.40, because then if you look at again, you look at the 200-day moving average, that thing at some point in the next few weeks is probably going to come up and get to that low. Like you can see the
Yeah,
white line there. Like that's starting to get really close. Like that is going to undercut that low, I think, in the next month or so.
right. That channel there. I mean, that's my approximation. But uh, Michael Oliver is a big proponent of that channel, and for him, above the channel means ignition. And for me, as a range trader, sometimes above the channel means okay, be long, but be concerned that we can go back into the channel. And so now, synthesizing what you're saying with his stuff and the moving averages, the moving average, the top of that channel, and the market could intersect in a couple months at say, 25, 25, and the market or 26 in about 5 months. I guess what I'm saying is similar to what you're saying about silver, is that the moving average uh, could catch up while we bide our time. So I'm not bullish. I'm not
Yes.
bullish, but look, I want to add this. The market is definitely different. And here's what I mean. I mean, the election is over. The easy money is over, right? Let's just be clear about that, right? We're in a hangover period now. People are like, oh, every news item they think gold's got to go up $50. No, the election's over. The impulse is over. But the what's the word I'm looking for? The sensitization to the risks is there now. So what used to be, well, the 200-day moving average is kind of the middle of the line for gold, has become the support. What used to be, I'm comfortable going short 2,000 contracts for a bullion bank overnight, is now like, well, I'm only short 500 contracts and I'm nervous. What used to be, oh, the rally is over gold and it's down $100, sell it again. There's another $100 to go in it, has become the $100 drop post election, followed by sideways. And so the longs are out. The macro discretionary is out. And I knew we were going to get to that eventually, but the macro discretionary is no longer positioned. But as long as we're above the 200-day moving average, they're always watching it for shorter term reasons to buy it. And this market seems to be catching its breath. What's the moving average concept you said? But at the same time, I don't see any. Look, who were the biggest shorts last year? The bullion banks, right? And that's their job, but they weren't expecting to get, reamed up their butts for as long as they did. And so those guys have to become the big shorts again if the funds won't do it. And they're not doing it. They've covered a lot of their shorts and they're reticent to play that bear side again. So I'm still looking for a reason to get short because the market peaks between now and February, and then it peaks again in August, and then it sells off between August and October. So I'm looking for that, and I'm not seeing it. I'm seeing a market that had a big dip and has shorter dips since then, and it's kind of feel like it's being accumulated again. So I'm coming to your side of the aisle on that. Let's put it that way.
Yeah, you would. I mean, to get short, you would need to see more strength. Like people, you see gold come up, and I'm just looking at maybe gold because you have resistance at 2,700. Maybe gold, you get another false pop above 2,700, and
Right.
people are it's broken out. The correction's over. It's going to go to
Yeah.
3,000
Yeah.
now, and then it you get short because it's at that point it's more likely to fall back in to 2,600,
That's funny that you say
2,550
it because
maybe.
that the emotional stuff you're talking about happened to me today, and I'll show you what I mean. Um, um, that's a little bit of a busy chart, but see these two moving averages here? That's the 50 and 100 day. Now remember, yesterday we went from the 100 day to the 50 in one day. Boom, like that. $30 rally. And all of a sudden it's like, oh, we're going back up again. And I'm like, I wanted to, but I feel like we're in a range and we're just going to go back and forth and hurt a lot of people until some news item comes out. And so that's why I drew all this stuff here. There's the wedge, there's the 100-day and 50-day moving average. And the fact that we went to the 50-day moving average and didn't break it today, makes me think that we're still in a range, but the low may have been in.
Yeah, and even and so let's say the low's 24.40 or 24.50, whatever it is. Even
Right.
if I'm wrong about that, maybe the low is like 2400 when it comes if it comes back down and you get a full retest. Like
Right, right, right.
because I think, and we're going to get in now. Moving on, we could talk about technicals and sentiment, or yeah, sentiment and fundamentals. But I mean, tell me about the COT because the speculative length in gold has come
Oh, yeah.
off nicely, but in the open interest, I mean, unless I'm reading that wrong, that seems to me that's come off considerably.
Okay. Let's we're going to come back and pause this because I'm going to pull the chart up you want to see right now. Right? It's one of my charts. I have it handy all the time. That's the chart you want
Okay,
to.
so Professor, there we see it. The chart of the open interest. That's only the open interest, correct?
Yes, yes, but I can interpret that for you for the speculative longs and shorts. So yeah, the point you made is that the speculative longs are out, and that's not labeled here, but the most recent commitment to traders reports and the analysis I get on CTAs says the following. CTAs, now, if someone says CTA, I want you to think hedge funds that are small to medium at best in terms of size, but they're also the most volatile and hottest money. They're out. They're underinvested in gold right now. They're probably all chasing Bitcoin. That's what they're doing,
Yeah,
and
or fart coin probably.
Farcoin. They're out of Bitcoin. They've rolled into Farcoin. It's the flight to safety. You go out of gold into Bitcoin, and then you go out of Bitcoin into Farcoin. And I don't know what's next, but I want to be a part of it. So all kidding aside, so the CTAs in the latest Goldman CTA report that I looked at, uh, the small and some medium hedge funds are underinvested in gold right now. The larger and MACD guys are not in at all. They're flat. They've moved on. Their money is, there's no big play for them right now. And so, as a result of that, your speculative length is out, and that will make the red and blue lines on this chart drop. The open interest. This is the area we're talking about. This is the area that you're talking about here, right? Here's the election. That's the gold market itself. There's the open interest. And since that time, it has dropped, but the market has now gone sideways. Meanwhile, the open interest continues to drop all the way down
Wow,
to here,
that's come down, yeah, very significantly from, I
right?
mean, if for those who are having trouble seeing the chart, from about 500 and let's say 70 or 580,000 contracts all the way down to what is that, like 430, 450, 440?
Or 50 tops, and
And and that is the biggest decline, it appears. I mean, in percentage terms, that's has to be pretty significant. Just looking over the last few years, that's one of the most significant. Other than it looks like 2022 to 2023, we could say yeah. Other than in 2022, especially for a market that's broken out, and has this huge breakout move out of the cup and handle.
right,
That's a pretty significant decrease in open
right. And
interest.
this is your cup and handle breakout area right here, right? Is that where it started? 24 in
A
no,
little bit below that, yeah, a little bit lower.
here. So
But yeah,
basically, it's like
but
here.
I think I mean, what you were saying about the uh, the macro discretionary guys and the hedge fund guys,
Yeah,
that's the fact that they're like all out. I mean, that's really significant that's happened. And gold is still, where is it at today? Over 2,600.
yeah, yeah. I think just to color in the lines a little bit. I'm gonna. Your intimation is that the open interest has come in substantially, and that means two things. It means the longs are out, and it means the banks have gotten their shorts back, some of their shorts back, but they're still short. And that's what these lines show. The other thing that I think is extremely important is that you're saying that the sheer percentage move in open interest from up there to down here was accompanied by a move in a market from here to here. Now, if you look at previous, I mean previous to 24. If you look at previous drawdowns in open interest, like this, that's about the same, maybe a little bigger. It was accompanied by drops in gold like this, right? If you look at this one here, open interest down, there, the market basically goes from here to here. But the point is the open interest is making higher lows, and every time it drops down, the market remains on a path with higher highs. So it would seem to me that, in the past, it would seem to me that post-election, right, with all these people getting out after the election, this market should have dropped down to here,
Yeah.
and it didn't, and it didn't. So, and that's one of the things that has been making me pay attention to the fact that, yes, there are no specs playing on the long side, but there are also no shorts that have enough money to play on the short side anymore. They're probably still licking their wounds. And unless there's a news item that gives them their confidence back to get short, the market should go sideways. I agree with you.
Yeah.
This chart, by the way, is from a GoldFix founder, Randy Blav. I want to mention that because he does a
Shout
lot of
out to
work on it.
Randy.
Shout out to Randy. There you go.
Um,
Uh,
yeah. So, and if we're in this consolidation, then I don't want to say, well, the only way gold comes down, but if we're in a consolidation, it's going back and forth, then, the worst thing for gold is it takes time and then, people get bored with it and maybe the bulls go away and it comes back and maybe it does I'm getting way ahead, but maybe it does a false breakdown at some point, later in the year.
right,
Because you,
right,
you can
right.
have
But
you can have that with consolidation. And then like if that happens when we're looking at the speculative length of the open interest, I mean they could be on the toilet by that point.
oh, absolutely. In fact, when you were talking about, what did you say? This could be the low in gold in terms of price, and then you
Right.
said it can retest it and maybe even break it. And then in my mind, I said yes, but some technical indicator like MACD won't confirm it. Or for me, an indicator for me is open interest. If gold makes new lows, but the open interest goes up in those days that it swoons, that's a sign that MACD is buying the dip again, and that would be bullish for the metal coming out of that. That's the that horseshoe config, not horseshoe, fishhook configuration that I like to look for. So I agree, I agree. But I'm not. I had a butterfly going on, which meant I thought the market would trade sideways, and I'm going to put another one on. I think again. So there's one other like psychological comment. Over the last forever, the sideways for gold was bearish. Because people lose patience. Well, maybe sideways is bullish now. And I say that because no one has an appetite to sell it. Now, unless producers come back online, I don't think it's going to be sold again. And China's appetite surprised everyone. China was supposed to stop buying gold, and in October and November they surprised to the upside, and they're hiding more of it again. So I have a feeling that that speculative length that dropped that red and blue line down is being replaced by physical demand again. So that's why it's holding up. Anyway, that's the idea.
Right. So let's I think one of the last things we'll talk about. Let's talk about the fundamentals for gold in terms of the specific drivers this year. And I don't know if you agree with me, but yeah, my concern, I think looking at the Fed, well, a positive going back to what we talked about, a positive is the market's only pricing in right now one or like two, is it two cuts you said over the next year, one and a half, maybe
Yeah,
specifically. And so that's what caused gold to decline. But yeah, that bad news, based on what we've been saying, that bad news is basically out of
right,
the market. The market's already digested that. And so that's the opportunity for gold. If you get a situation where the stock market corrects, economy's slowing down towards recession, then the Fed has got to get off their ass and start cutting again. Everybody's wrong about, oh, the Fed needs to hike or inflation.
right.
Um, that I think to me that could be the really powerful catalyst for gold this year to make that big move up. But the question, of course, I mean, it's a question of timing, as everything is. And I mean, who knows? I mean, that could take all year. Maybe it only takes 2 or 3 months. But to
Right,
me,
right.
I think that's the fundamental driver that we have to watch to get gold off its ass now. I don't know.
Right.
Maybe I'm wrong. Maybe I'm missing something, something else. What do
No,
you
I
see?
don't. I don't think you're missing anything. I think there's something to add though. So there's two pieces to it, right? Uh, Forever, all we talked about was Fed policy affecting the price of gold, right? Well, now, and this is very current events. I did this analysis yesterday, um, or I updated the analysis yesterday. That if the Fed has decided to only cut whatever it is, 1.5 times, we'll just make a number up, for 2025 altogether, right? Then the gold market has already discounted that, or at least is aware of it. Okay, so let's pretend that the Fed doesn't cut any more than 1.5 times. I'll tell you who's going to cut. I'll tell you who's going to stimulate. I'll tell you who's going to go crazy. China. They have to. Now, I'm not here, making the whole China's going to cut, buy gold, click on my, subscribe YouTube thing. I mean, I know that's the idea, but it's not, we're not preaching bullshit. The fact of the matter is China's economy is feeling it can't get out of a rut. At least that's what the world sees. That's number one. Number two, they have continued to buy gold because of Trump. That's what people are saying that I'm talking to. They're like, okay, the tariffs could be a problem for us. Number three, 2 days ago, this is extremely current events. It became apparent that China was going to back off on their stimulus, or at least hold a portion of it in reserve to see what the tariffs that Trump threw out there actually were. And when that news hit the market, China's stocks, the Hang Seng Index, 2 days ago dropped 2.8%. Now, you have a country, this is gold, this is about gold. You have a country whose bonds are yielding 1.65% on their all-time lows, their 10-year bonds. And then you have a stock market that craters almost 3% in one day because China says we're not going to stimulate tomorrow. Now, what do you think gold would do? It's rhetorical. I'm not trying to quiz you. What do you think gold would do if China said we're not going to stimulate, especially since China has such an appetite for gold? Well, gold would drop, you would think, and I'd be wrong, because when they back off on their stimulus, China's stocks dropped and everyone in China put their money in gold and bonds again. So yesterday, when gold rallied $30, $33, that was on the back of China not cutting. Okay. So when China does cut, it's not going to be an opposite day. When China does cut, gold's going to rally 50 or $100. So if the Fed, bringing it back to the Fed, if the Fed does nothing for the next 8 months, China will have to overstimulate because we're not doing it for them. And I think with China's bidding for gold, the Trump loose cannon factor on tariffs, and the Fed staying put, I think you're actually going to see uh, an upside event surprise us for a change. Not a war, not an election. Like we're going to stimulate again, and China will do that. So that's my catalyst, right? The fundamentals are what you just said they are. For me, the catalyst is the upside catalyst is if China says we're going to stimulate. The downside catalyst is if Powell actually says I have to hike, and I don't think that's going to happen. That'll just destroy their credibility. So that's it. I agree with you on the fundamentals.
Okay, I think we touched on silver. I had that on my list. We touched on that at the beginning. Is there
Yeah.
anything that else we need to add about silver?
Uh, uh, I don't think so. I think that, we talked about the open interest and the players in gold. Similar in silver. Everyone is selling. Look, everyone is now. When I say everyone, I mean smaller and medium-sized hedge funds, they're all short copper, getting close to their maximum short allocation. In silver, they're just starting to get short, and they can get very short. They got very short in 22 when the Fed was hiking. If they get very short again, then there's your catalyst higher. And I don't think we'll see that unless silver drops, meaning if it drops, they'll throw more money into it. That's their momentum style. And I know that there's physical demand in silver right underneath the market again. So I would welcome a 50 cent or dollar drop that lasted about 2 weeks, because then that would be the catalyst for us to go higher. Long story short, uh, I will buy gold if I see silver get above the 200-day moving average. I will buy silver if it drops and gold still remains in the 200-day moving average area. So that's kind of like how I'm trading them against each other right now. So that's it.
Yeah, one issue with silver is the gold silver ratio. I'm sure you've looked at that. That's kind of in a base. So there is some technical risk for silver
Yeah.
that you could get. That's the thing. I mean, what if the Fed has to cut like multiple times, not a lot more than they think?
Right.
That gold silver ratio could break out and pop up. Gold could, you would think that news could be really bullish for silver. And I think it would be eventually, but maybe not
Right.
initially, because just looking at,
No. Yeah, you're right.
again, the
You're
gold,
right.
I probably should have had a chart prepared. I mean, I guess I could put it in after the fact, but the
Yeah.
gold divided by silver, that's trading in a range. So if that, well, actually, the breakout would probably happen. The breakout would probably be a signal to the Fed. Like that would probably be accompanied by other issues that would force the Fed to cut. So in other words,
Yes.
that breakout would probably be a signal that the Fed has to cut or will cut. And then of course you would want to buy, you get the breakout, you get a big pop in the ratio and it goes to
Right.
100, 105, whatever. But that's actually when you want to buy silver, like you were saying earlier, like you would be a
Right.
buyer.
Right. Let me map that out for you, but not using gold and silver, because I'm going to tell you what Hartnett says about stocks and bonds, and it's exactly what you're saying about the Fed and gold and silver, and the gold silver average. He says on his radar, and it's been on his radar for a couple months, but I think it's getting closer. He's saying stocks continue to go higher, bond yields continue to creep higher. Bond yields get to a level that are just too much for stocks anymore. Stocks crap out, bonds get stronger, the Fed must ease. Now, if as everything I just said to you, that means silver gets crushed, right? Stocks crap out, silver gets crushed, bonds, it's like flight to safety in stocks is flight to safety in metals. And when all that happens, then Powell says, and he hits the button, and he has to print to save the stock market. And in doing so, he enables the silver market to explode. So Hartnett has said the same thing that you've said from a statistical fundamental point of view, governing stocks and bonds. And I believe it echoes the behavioral pattern that you're looking at. And that behavioral pattern being, if something craps out in the stock market, let's call it COVID 25, let's call it China refuses to stimulate and they go into a deflationary spiral, whatever you want to call it, aliens land and they say that our stocks are worthless, then Powell's going to cut. But before he cuts, gold will rally, silver will crap out, and then he'll cut, and then that'll be it. I think it's not unreasonable. It's not unreasonable.
Yes, because it's not unreasonable, but that's a contrarian take because if you look at the positioning heading
Yeah.
into the year, as we talked about, and one thing on silver, I looked at the speculative length in silver. That's come off a lot more than it
There's
has in
nothing in there.
gold.
There's not, they're
That
short. Look,
yeah,
I'm sorry to interrupt you, but they speculators are short silver now. They're not long at all. Net. You're right. It's just an easier trade to do in stocks and bonds right now than what we're talking about. And this is not a stock and bond show, but the market is so short bonds right now that if stocks were to crap out, all those speculators that used to be long silver, they're now short silver and short bonds. So what's going to happen if stocks crap out? They're going to buy bonds. They'll add to their silver, right? They'll add to their silver to hedge their stocks. And then Powell hits the button and he nukes them and silver rallies. I think you're right.
Yeah, still have a little bit of time, Professor. Anything else that we should cover?
Uh, no, but I want to do an honorable mention of the 60/40 portfolio. I think this is the year we get the breakout, and we get that breakout because stocks drop. I'm not saying gold won't go up, but I'm saying this is the year that I think the bond market rallies and stocks drop more, and the Fed ends up having to cut in the last quarter of the year. Like there's a big split in this marketplace. Jobs are healthy. Everything seems healthy, relatively speaking, for the economy. But there's some liquidity crunches going on, and the Fed's going to have to do something about it. I don't know what they're going to do. Our bond yields keep creeping up. So, what's gonna what's gonna stop everyone from pulling their money out of risk and putting it into something safe? I think the bond market's going to rally. I think stocks are going to go down, and I think your 60/40 portfolio finally gets beat by gold. That's it. I'm rooting for it. Let's put it that way.
Yeah, I was thinking about that yesterday because every time the market, I mean, I'm just thinking very recently, every time the market has been hit, corrected, COVID crash in the last 5 years, whatever,
Right.
um, gold has really outperformed the stock market. Like during,
Right?
because the bottom, gold against the S&P and probably gold against the 60/40. I haven't looked. I mean, I should have that memorized. The bottom, I think, was the very end of 21 and the market peak then. So if we get a market peak sometime this year, and even if the S&P is just down 15%, I still think that ratio is going to break out in favor of gold. Like
I think
I don't think you need to see like a full-blown bear market.
no, you don't. Exactly. I think you could just kind of like, right, right. But there are other analysts out there looking at this, not the way you're looking at it, which I think is actually probably the better way. I would just look at, they'll look at the Dow versus gold. And by the way, reputable, not hacks. The Dow versus gold. What would make they were talking about the 2008 scenario, which we did not have. They were like 2008 scenario was stocks go up, bond yields go up, oil explodes, and that causes everything to crap out. So it's kind of like the Dow and gold trade at the same price. That concept. And they were talking about it again this year. They're like, okay, gold goes to 3,000 and the Dow could go to 3,000 if interest rates keep climbing. Well, interest rates didn't keep climbing. This was like about mid-year last year when Yellen screwed up over in China. But that might be the scenario we have this time, but just not so extreme. And that would be the scenario you're describing, where bond yields go up. Uh, it takes money out of stocks. They go into bonds. Stocks start to crap out. The 60/40, which is 60 stocks and 40 bonds. Finally, the bear market in bonds, uh, uh, goes sideways, and the bear market in stocks uh, starts, and then you have your 60/40 getting hit. But a lot of other analysts are looking at it too. But I think they're trying to parallel it with 2001, 2006, and I don't see it. I see it more like the scenario that you're looking at.
Yeah, I mean it could be a combination of various parts of it. Everybody's looking for like a perfect repeat
Yeah,
of 2007, 2000. It doesn't work that way. Every downturn
no,
usually is its own animal.
exactly, exactly. Anyway, so yeah, I think we covered it. I think we covered it in decent time. Did we?
Yeah, yeah, we did. We still have a couple minutes left. So, Professor, before I let you go, please tell the audience where they can go to subscribe to your Substack.
Sure, sure. It's goldfix.substack, vblgoldfix.substack. And well, we cover the precious metals and inflation and deflation and macroeconomics and geopolitics. And we'd love to have you sign up for free. And we did not run any specials this year. Uh, at the end of the year. But we're going to in a week or two. So if you're a new free subscriber, you'll learn about that. If you are not a free subscriber, then you won't learn about that. So we're not going to go out there and saying sign up and we'll give you, uh, a free hat, one of these. That's not going to happen. We're just going to let free subscribers that are already subscribing know. So sign up if you want to, but do that, after you sign up for Jordan's Daily Gold.
Well, thank you for the plug. And thank you all out there for listening. And Professor, thank you so much for coming on. Really enjoyed our chat. We'll go a little bit longer at the end of this month. A happy new year to you. And that's all I got for today. So we'll wrap things
Happy
up
New Year.
here.
Happy New Year to you and your audience. I'm happy when I come on here. These are always a lot of fun.
Thank you for tuning in to the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.